All right, good morning, everybody. Green on the screen around the world. The markets liked the data after they looked into it a little bit more yesterday, but we also found support on the put wall yesterday. That's where the S&P turned and started moving in the other direction. That was all CPI. Now we're going to get data out of Europe with their rate decision. This is very much like our FOMC, only it's for Europe. So we got to get through that. That's a really big deal. It's likely to move the markets. And then we've got job numbers and PPI. And then we've got auctions, the big one being the 30-year. And do not accept this idea that the 30-year is something that you can ignore or be complacent on. Some of the biggest moves I've seen on an intraday market has come from this 30-year bond auction. So do not discount this one, right? Watch the clock, keep your eye on the ball. We had the 10-year yesterday, and you seen what happened at 1 o'clock. It was that last little bit of juice that got us through resistance. So that rally spread around the world. And then the data we got out of Japan kept everything going. And now it's back on us again. So we've got the dollar sideways holding out, S&P, NASDAQ, 10-year, everything just sideways and holding out. Now, some of this is because of the rate decision today out of Europe. And the other half of it is the job numbers and the inflation data we're going to get today. We're still looking at elevated volume today. It's more volume than we had yesterday, but it's in line with the kind of volume that we've been seeing over the last week, which to me still implies we're seeing a lot of rolling right now. We're seeing a lot of movement into the new contracts. A lot of these firms aren't going to wait to the last minute before they start to roll. If you read the Spot Gamma founder's note from last night, I know a lot of you don't. You just focus on the AM note. But we don't have the AM note yet. And then yesterday, it got here late, right? It was after 9 when they finally published that thing. But if you read the one from last night, they put us back in green light conditions. It was that break above 5,500, the one that stuck, right? When we finally got through that resistance. So here was 1 o'clock. We got the auction and a little bit of pullback right there at that 5,506, 5,500 area. We buzzbeat off that 55, and then away we went into the afternoon. But we're above zero gamma, the volatility trigger, the put wall. We are above the 10-week, the 3-week, the 10-day, the 20-day. We're above everything, right? There is no moving averages or resistance above us from any of that. Now, that doesn't mean we can't fall, right? It's worth stressing the idea that we're still in a violent market. This was a recovery day of the sort that we haven't seen since the 2022 bear market when we did that flip reversal. Down more than 1.5% and then rally up like we did. It's a big move. Markets don't move this violently normally. So it is still a dangerous market to see these sort of moves. So we're not out of the woods yet. That has to be recognized as a threat. Today's channel is a really wide channel, and it's overlapping with yesterday's channel. The biggest channel here, that's the weekly. So we are above the weekly pivot, and we're outside of that weekly channel. This channel is today's CPR, central pivot range. It's overlapping with yesterday, but it is above yesterday, which is considered bullish. Price is above the channel, that's also considered bullish. We're not just above the pivot, we're above the pivot and the channel both. A wide channel implies that if we break out, it probably won't stick. But with the violence that we just saw, just keep in mind that these channels do not make price do anything. They're just giving us an idea of what we should expect out of price today, but they don't make the market move. For the average daily range, we are closer to the upper edge than the lower edge. But because of all the economic data, there's no way we want to try to pick which side we think we're going to hit first. In this market backdrop, as soon as we get new moves, we're not going to have any pivot that can give us some insight, right? The data is going to come in, and it's going to be just like CPI yesterday. We're going to get a very large candle and then a reaction from that. So today is another day where we could get a gap close play. We want to be prepared for that scenario. It's the same setup. It looks exactly the same. Everything that we talked about yesterday, it's on the table. And then at 1 o'clock, we have a chance to see another liquidity gap, because that 30-year, it can be a beast. There is a history and a precedent of seeing the 30-year make some really big moves. $55.32 cog line is the midpoint of last week. Now that we're above it, we need to keep it. Now, it's only 30 something points away from where we are right now. So we could go down and hit it. We can see that the ADR of yesterday is 55.20, and we're talking about 55.32. So it's kind of close to that lower edge. And from a bullish standpoint, if we want to be bullish in the bias, it would go a long way to get a little bit of a pullback first before we continue the move up. We do have yesterday's candle that we can analyze. This is the liquidity zone that we get if we measure yesterday's range. And keep in mind that the liquidity zone actually expands all the way to the top to the 1, 2, 3, 6. It's just that most of the time, if there's liquidity above the pivot, it's in the lower half. So tend to pay attention to that more than the entire range. But still, the entire range does show the liquidity. So if we can get to 85 and we can get above it, then we'll target the roundy 5600. If we can get through that, we'll target the cog line 5611 and then 5632. And then beyond that, this high from back here. It's always level by level by level. Ten-day, 30-minute volume profile. We're not expecting this to change anytime soon. The one thing that I see that could make this change quickly is if we get back up into that 5611 area up here, we could bring the point of control back into this zone if we can get up here and develop some volume up there. And it wouldn't be that surprising considering we've already got volume there. So if we run up and we hit this old trading volume and it stalls us out there, or if there's a lot of traders remorse, so we run up and get back into levels that they previously had traded, it can bring our point of control up. There's also the idea of reciprocation. This is an old school market concept that says if you get X distance on one side, then you are owed X distance on the other side. Well, game that out. We had that much distance on one side. We could get that much distance on the other side. What it forms is a pattern that I don't really have a name for. I've kind of been teasing the idea of a zipper pattern, or the name for it being the zipper. But it's a pattern that we just don't get enough for me to be able to do a lot of research on. But reciprocation is a big deal, and it's everywhere. Reciprocation above and below VWAP, above and below a key moving average like the 10, profile points of control like this. We get reciprocation all the time. And as odd as it is a market structure that exists. So you kind of want to understand it, pay attention to it. The point of control on these two do not match right now. They're not even close. The profile in blue is what we call a TPO profile. That's different than a volume profile. I know they look the same other than the color shading, but they're actually two different things. One is what we call volume by time, and the other one is what we call volume by price. TPO stands for time, price, opportunity. The easiest way to try to think about these two is that volume, just like it sounds, is monitoring how much volume we had at that price. The other one is how many trades did we have at that price? Well, those are two entirely different things, right? Because you can have one trade with 100 contracts. The volume would read 100. The trades would read 1. So we can see the distribution in the trading yesterday, have a better sense of the sort of volume we came into near the end of the day yesterday, and the significant amount of resistance that we had to deal with yesterday, trying to get back up through that Globex zone and then out the top. So we talk about liquidity being on the other side of the pivot. Yesterday, that was our high until we broke out above it. And look at the significant amount of resistance there, the amount of volume that we got into at that level. And then the volume died off. We got this shallow area. And then we ran into another zone of high volume. And then that died off and we got into another zone. We have a VPOC now, thanks to yesterday. the difference between a POC and a VPOC is, has it been hit yet since that day that it was made? Right, so this is yesterday's volume profile. That's yesterday's point of control. After the close yesterday, and we went into the Globex, we haven't hit this level since then. That's why it's a VPOC. If we look back on Monday, for an example, Monday closed, we opened up Monday night into Globex, we would have had a VPOC there until around 2 a.m. Tuesday morning when we hit it right here. At that point, it was no longer a VPOC. We wouldn't keep it anymore. Now, the textbooks will tell you to carry these lines forward whether or not they've been hit. And there's nothing wrong with that. I'm not against it. It's just I've got so many levels already that I don't need yet another one. So I only pay particular attention to the ones that have not been hit. But that doesn't mean that you can't, right? You can keep track of all three of these, just like the textbooks say. So that was a really fast move yesterday. It's got to have people wondering, did we move too far, too fast? Are we overbought? And does it owe us a pullback? On the weekly, no. We're not overbought on the weekly. We're not overstretched. It doesn't owe us any sort of mean reversion. On the daily, we're not overbought here. We wouldn't get into that sort of market condition until we were at least 1.5% away from the 10-day moving average, and we're not there. We're 0.5% away from the 10-day. So we could easily go another 1% above that 10-day before we'd even consider the idea that we are in some way overbought or have moved too fast. Now, make no mistake about it, it was a really big move yesterday. From the lowest point of the day to the highest point of the day, it was a fantastic move. And that's likely going to adjust our ADR in the next few days. But if we only look at how far the market moved from close to close, it wasn't that extreme. We are outside the box. We can consider as well how far outside the box we are, if we are, just one more standard deviation or not. That would get us into 5,600. Maybe even 5,611, the little bit of an overshoot. Now, these reversal days where it's really negative and then we rally up, it's really bullish to get that sort of reversal, but that's not in the right spot. I've shown these reversal days before where it's negative and we have a couple of red days in a row, and then we open up and we get even more negative, and then we rally back up and we break the previous day's high and we close at this really nice high level, right? That's a beautiful example of the kind of follow through that we want. Or back here where it was really negative when we broke a major level and things started to pick up speed. We fell really far and we had that reversal day and the follow through from it. But this isn't either one of those. We already had our negative, and then we were just chopping around sideways, staying inside the range. So this dump and reversal and then breakout is not the same as those other ones. It doesn't mean that the outcome won't be the same. Just that I had already seen articles trying to suggest that that recovery move yesterday matched two other time frames where we had these really nice rallies, and this is the kind of move that you're talking about. I'm going to argue to stress a little bit of caution here. This is like a TRB setup, and we were trapped in that range until the big move day. Then we had a little bit of digestion and then move right back up to the top for the TRB. So we've got our first big day. We could digest for 1 or 2 days, but there's precedent for multiple big days. Just because we moved really far yesterday, don't think that we can't move really far again today and even again a day after that, because that's possible too. It's easy to discount the idea that we can get 2 big days in a row, but we can, especially with Europe on the table and then PPI and then the 30-year. There's a lot of data coming in and job numbers. Can't forget the job numbers. So this market is looking for an excuse. And yesterday, funds were forced into chasing that bullish move, whether they liked it or not. They had to. They don't get to choose, right? Non-discretionary traders, they have to just follow the signals. Well, they'll follow it the other direction too, right? So just keep that in mind. One of the tells that I had yesterday that put me in a bullish bias, which was odd because I was in a bullish bias and we fell 1.5%. And I kept saying, something's wrong, right? This is one of these two are lying to us, one of these four. And that's because yesterday, as we were nearing into the open, the peso yuan or won, that sucker was still ripping up. The ES was sideways and it wasn't moving and it had fallen some. Like this isn't supposed to be moving opposite, right? That was one of the indications. But look at the move in the 2-year yesterday and the Dixie. So now we're back. We've got the 2-year sitting near the high of yesterday, the ES way above the high of yesterday, and the dollar near its high of yesterday. Everything, just all of these are sitting up near the top of that range. And we're going to get this data today. Even the peso yuan. It's Mexico, Japan, right? So all of these are sitting up in the upper part of their chart. When we get the data today, we want to see if the ES moves with the dollar to the downside or moves opposite of the dollar. Get some insight from that. The 2-year, the 10-year, the 30-year, what's going on? Keep your eye on those. If they're making big moves or not, if they're stalled and not moving at all. And then the carry trade, the peso yen, whether it's moving or not. I'm sure there's a better proxy for that than peso yen, but I don't know what it would be, right? So that's what I use for the carry trade. So I don't have anything better. So we got the VIX here. We're on a daily chart on the VIX. This is the market environment where it's just a pullback. And what it's referencing here is in the S&P, after this move up and this move here, it's just a pullback. That's it. And if you want to zoom that out a little bit more for the S&P, that all of this, it's just a pullback. That's what the VIX is telling us right now. But you can see through July and into September that we've been in the correction, deeper pullback territory. So we want to see the VIX continue to fade. Let's get it underneath that 17 level first. Then we'll focus on $15 level by level. The monthly anchor on VWAP for the ES is not really something that I like. The monthly just seems to be pretty worthless, but the anchor on the week seems to have value. You can, of course, mark last week's, which is what I have marked here. 55.18 was last week's VWAP. And then you can also ask, where's VWAP this week? It's anchored, so it started on Monday. It's this yellow line down here. Distance from VWAP matters. Even in this context, distance from VWAP matters. So we've had a big run. We've gotten into some liquidity that stalled us out. We've got really big data on the table. Be mindful of this distance from VWAP because it goes back to reciprocation and getting what we owe on the other side. Everything is up this morning. If the benchmark is 0.5%, then we've got energy, banks, Bitcoin, uranium. But what we don't have up more than 0.5% is the Mag 7, semiconductors, and we would want those, right? Consumer discretionary products, growth. We don't have those. It's moving in the right direction. We can see that they are up some. They're just not up enough. TLT made it above 101. It wasn't able to keep it but we did get that breakout up there. Now we're breaking down below yesterday's low. We've come back inside a little bit, but it doesn't look like that's going to hold, and we're probably going to fade out a little bit more. Still bullish, big picture, right? We're still holding above 100, but we did get through that 101. We just couldn't keep it, right? So let's come back down and test 100, see how it responds around that level and whether or not we're going to be able to keep that level. Nice reversal in crude. Just remember there's hurricane stuff and weather affects this. Same with the data that we got yesterday. We got crude inventories and all of that at 10:30 yesterday. Hot stocks, but it's just an algo print. We're not seeing any real flow there this morning. Same thing with airlines. There was Southwest, I believe, that has activist investors messing with the board and kind of trying to shuffle the pieces around. So there was news on that this morning. It could be part of the reason why jets are up, but it's still just an algo print. We're not seeing any real flow here. Same thing, uranium. It's got this awesome little H pattern, but we're under that 50 period moving average. So until we can get through that, there's a 3-bar reversal here that we've got to get through, that $27 level. We've got to get through that and completely above it. Then we've got the anchored VWAP up there. So if we can get through the trend line and the 50 and this 3-bar flip, we've still got issues at 29. Little bit of a move in the Bitcoin proxies, but I mean, this thing is beaten down. It's got a lot of work to do. Small caps getting a little bit of love on that bounce of the anchored VWAP. Nice follow through so far. But we can see the previous selling around that 212 level. So that's still going to be a significant level to get through this time. You can see peso yen it's just beat down, right? We got to get things turned around here. And so we've got a lot of markets that are up. They're just not necessarily the right markets. Apple inside day. Sure, we closed up there near the highs, but we never made it outside of yesterday's range. And right now, that's the level that we've got to get through. And we can see all of these buyers and sellers just trapping this thing on each side, right? Big wicks, both sides. It's got to get out of this zone. And when it does, we got this half back from this big earnings bar, and it's already been tested. So far, we haven't made it through there. Amazon, same thing, stuck in the range, needs that inside day breakout. Got a liquidity gap to close at 190. Now Google's got the breakout, so it could stick, get a run back into that 158 anchored VWAP area, but not really expecting much more than that, which is pretty close to the half back anyways. Sure enough, it lines right up on it. 158. Microsoft is still stuck inside of yesterday's range. That last big bar holding a lot of these back. So we've got a lot of bullish spaces out there, but we need the Mag 7 to step up. Consumer discretionary. The financials need a lot of help. And we're all still kind of watching what's going on with the weighted versus the unweighted markets, right? That flight to safety with healthcare, utilities, staples, that changed yesterday radically. It took a significant beat down. Added to with that, the financials and their beat down this week, then we've got just absolute market chaos. If the Mag 7, which is way overcrowded and still way overbought, if money doesn't flow back into that, but it's bailing out of the defensives, then where the heck is it going to go, right? Yeah, I mean, the election has to be thrown in there too, right? They can try to juice it a little bit more. A lot of the moves we saw this week came from the idea that if the Fed was going to cut 50 basis points, that would spook the market and send us into a tailspin. And so we were getting some data that suggested that they wouldn't need to cut 50 and that they could gradually approach cuts, cut once, pause for a couple of sessions, and then cut again and then pause. So there's just a lot going on. And a lot of this is going to be out of the hands of those market manipulators that we generally get, right? The PPT, plunge protection team, and their ability to manipulate the markets is historically precedented, right? They can do it when they want to do it, but some of it is just out of their hands. Like Japan, and what happens if they do raise again? How Europe does this morning with their rates. What Christine Lagarde had to say afterwards, right? Because she's like the Europe version of Powell. So be careful, be safe, watch the clock. Remember, we got a lot of data today. And don't discount the idea that just because we had a big day yesterday, that we can't have another one today, because we can. I'm not saying we're going to, I'm just saying we can have two big days in a row, up or down. Yep, never say never. Old market can do anything it wants to do. We'll see y'all tomorrow.